All right, welcome to the Sherman Show. I'm here today with my co-host Sam Lau.
Hey, hey.
And for our second podcast of 2020, we have a very special guest, a Canadian here in the LA offices, David Rosenberg. Welcome, David.
Thanks very much. It's an honor to be here, and not just because of the weather.
Okay. Well, usually the weather is assumed, so okay. Exactly. So we appreciate you pointing that out.
Exactly.
So anyway, Dave, been a fan of your research for many years. Followed you back when you were at the old Merrill Lynch days, pre-crisis. I know you spun off and went to Gluskin Sheff, right? But I think you have an announcement for our listeners today that you've started your own research firm. It was Rosenberg Research and Associates. Is that correct?
That's right. Rosenberg Research because I love alliterations.
Okay.
And
Double R.
And Associates because I've staffed up with a COO and an office manager and three excellent economists. So we really have a great team. And actually today is the launch.
Okay.
So you're asking me probably then what are you doing here?
Yeah.
So anyway, well, to be part of the conference, be part of the podcast, but also I have a team back in Toronto looking after things.
Okay, good. Well, research never sleeps, as they say, right? So to our listeners out there and those watching on the YouTube channel, what can they expect from Rosenberg Research and Associates? What do they expect and what can they get from you?
Well, it's the old and the new. So for anybody who has been out there reading my dailies, what used to be called Espresso with Dave and Breakfast with Dave and Buffet with Dave. You see it always comes down to food. Mm-hmm. But I also periodically did speeches and conference calls. What's different now is I'm going to be maintaining that product line, but adding a lot more. So if you want instantaneous data analysis that's moving the markets, I'm going to be providing that where I didn't before. In-depth reports, we're going to do our own, but if you want to commission us to do a special report for you, we have the resources to get that done. And I'm also going to be including in my weekly a range of technical analysis called Technicals with Dave, which I haven't done before. And it's really combining all the different disciplines. At heart, I'm a fundamental economist. Mm-hmm. But, I think it was Mark Twain that said, what coined the phrase, lies, damn lies, and statistics. The one thing that I do know after being in this business for over 30 years is that charts don't lie. So I'm going to be having not just my chart book available for subscribers, but also a weekly set of technical analysis telling you, or things, whether it's it could be corn, it could be crude, it could be copper, or it could be treasuries, equities, or ratios, are things breaking up or breaking down. Mm-hmm. And you'll also have the opportunity to come to me and say, hey, can you look at this for me? So actually, when push comes to shove, it's going to be the same set of product service I did before, but we're also going to be the go-to economics department for firms or for people that actually don't have an economics department. They can come to us. And what really makes it different, for the first time in my professional life, I'm not working for a big institution that has something to sell. So all I have to sell right now are my unadulterated, unabashed, untethered macro market views, for better or for worse.
Right?
And then you make up your mind how you want to invest around it. But we're there to be the advisors that we like to say in the website. We call it, we are the ones that are connecting the macro and the markets and providing really a framework for investors to make the best possible decisions.
Yeah, well, congratulations. Thanks for spending the kickoff here in Los Angeles. But I think in order to really help you promote this, we got to talk a little bit about your background. Why espresso with Dave? Why breakfast with Dave? Why high tea with Dave? And all the buffets you said. So give us a little bit of your background. Did you grow up always wanting to be an economist?
No, actually, it's interesting that you asked that. When I was in high school, I actually took economics in my senior year, and when I came home and my father asked me, so how was your economics course? I said, well, Dad, we assumed a small open economy with no government, the classic Keynesian model. And my dad said, son, I want to show you my paycheck. And, of course, this is Canada, where over 50% of my dad's paycheck went to the federal government. And my dad said, any course you're taking where you assume no government, my suggestion to you, Dave, is drop it. So I did. And then I actually went to University of Toronto in 1979, and I actually enrolled to be in the Bachelor of Commerce program. I actually wanted to be an accountant. What I tell people today are just economists or accountants, but with personalities. But I actually started off in the Bachelor of Commerce program. And by December 1979, I'm passing every single course brilliantly, except the one course you'd actually want to do well if you want to be an accountant, which was financial accounting.
Financial accounting, right. Yeah.
I was the worst mark in the class. And so I go to my professor in December after the midterms, and he said, "Look, Dave, you just you have a mental block. You just can't balance the books." So I said, "Professor Lee, what do you advise your students who can't balance the books?" He says, "Oh, I always tell them go in economics." So that's what I did. And
I love the major bashing from professors, right? It's like
it's so that's really it's not that I guess the way I would say it's not that I found economics, and more or less it found me, and then I realized that it just combined a lot of things that I love to do. It combines the quantitative part. It combines the history part. It combines you have to have an ability to write and communicate, and to really, in some sense, it really is a study of human behavior, of social behavior. And so it combines history, it combines math, and look, you have to take economic history because it tends to repeat itself, right? Something else that Mark Twain said. Mm-hmm. And you also have to take sociology and psychology. And really after the year we had in 2019, I could see why you have to take a psychology course to get through economics. So in answer to the other question about, this Breakfast with Dave, which became its own brand, I started doing this daily back when nobody was doing dailies, and it was really just after the internet. Nobody was really sending stuff out. People weren't getting 250 emails a day. Email was relatively a new thing. And this fellow named Bill Down, who was the number 3 guy at the Bank of Montreal at the time, that's where I was, he ultimately became CEO. He had just started in the Treasury Department of the Bank of Montreal, heard me give my morning meetings. I used to do the morning meetings for the institutional group, and as you can tell right now, I talk really fast. And that's what he said to me. He said, Dave, you talk really fast. It becomes broken telephone. Why don't you get your morning meeting down on paper? And then call it something sexy and we'll market it. And that was in 1998.
Wow.
And so it was called something, it's been called different names, but I started at the Bank of Montreal. I left my Bank of Montreal in early 2000 for Merrill Canada. I took it with me. It developed a huge following in Canada. And actually, it got me top ranked in the surveys for economists on Bay Street, and I took that to Merrill Canada in 2000. In 2002, the powers to be in New York liked that I was taking economics and strategy in Toronto and commercializing it in the sense of making it interesting but relevant for portfolio managers and CIOs. So I got the top job in 2002 in New York, and once again I brought it with me. At that point, we changed the name to Morning Market Memo. Once again, I told you I love alliterations, and that's what it was. And I was actually told by the time I left Merrill in 2009 to come back to Toronto, I'd been gone way too long, and I was, trying to balance 2 lives: my professional life in New York and my wife and kids were back in Toronto. But when I got hired by Gluskin Sheff, reality is that Merrill Lynch owned the copyright or the trademark to Morning Market Memo, and I thought, actually it was my youngest son, Michael, who we were having breakfast, and he says, "Dad, it goes out early in the morning, right?" And I said, yeah. He says, well, why don't you just call it Breakfast with Dave? So I'd like to say that I get the credit, but it's actually my youngest kid, Michael, that actually and it stuck. Mm-hmm. And so
I was thinking it would be like Dave's Donuts or something, since the alliteration. Right?
Dave's Donuts. Well, I've been battling weight problems my entire adult life, so I'm trying to stay away from that. So let's just call it, egg whites with Dave and whole wheat toast. But anyway, look, it's a daily distillation of my big picture, small picture views. And the reason why I have the espresso was because years ago, subscribers were saying, I'd like to get out your first thoughts when you get up, your very first thoughts. Mm-hmm. So the espresso is really just a stream of consciousness and like the first waking hour of the day. And breakfast has a lot more meat. But, look, in the final analysis, the customer is always right. And so, why do I have the buffet with Dave on Fridays is because people would say to me, well, I can't read your daily every single day. Because the daily could be as short as 10 pages or as long as 30 pages. It depends on how many charts and maybe how much Pinot Noir I had the night before. But the buffet is really the best ideas from Breakfast with Dave. And there's some people that just want the weekly. Some people, will read the daily religiously. Some people just might read the espresso. So really what you try and be to your subscriber base is all things to all people and make them all happy.
So how do you come up with 10 to 30 pages of content a day? Now, granted, you said depending on the number of charts, but when I think about the economic data set that I look at every day, I can't imagine, putting that much together. I kind of cheat and use the eco screen on Bloomberg and have it tailored a little bit to what we're looking at. But how does one have that passion every single day? Is it the Pinot Noir at night? What is it?
Well, it's a combination of things. Look, I'm fortunate that I've never considered what I do, and especially from the time period where I actually got the chief acknowledgement, the chief economist, which would have been the tail end of '99, and I could direct the research. I had the resources. I love what I do. This is a passion for me. And look, I'm not an economist of the Conference Board. I don't work at the central bank. I don't work in the government. I don't work in academia. I love the markets. Now, I'm not a portfolio manager like you are, and I'm not a market maker, but I like to be that cog in the wheel that helps people like you make decisions. And what's my skill set is basically sifting through the data, and trying to see things other people aren't seeing, and then how is this going to influence the markets? And so I have a passion for it. I don't consider it work, actually. It sounds a little weird to compare like an economist on Wall Street or Bay Street to a painter or a writer. It's just it just becomes a part of you. I have to say that it's no different than how I would wonder how William Safire used to feel when he wrote what I thought was the best editorial sections of all time, how he must have felt about penning that every single day. How could he find something to say every single day?
Right.
And but you can see there was just this passion, this love of being creative. And that's what I like to think that I do, being creative, but also being relevant and connecting those dots. So look, every single day, new data come out. That either challenge your view or new data that comes out that supports your view. And so I like to dig through the data. And I always tell the staff that's worked for me for the past 20 years, I tell them over and over again, the important thing, if you're going to be a financial economist, you have to stand out. Now, standing out doesn't mean making outlandish calls or purposely being against the consensus. It's really finding things nobody else is going to find. And so that's really the ethos that I work with. So every single day data is coming out, and you can look at the non-farm payroll number, for example. We're going to get another one. What does it mean for the Fed? Was it strong, was it weak? But there's a cornucopia of information out there, and what you try and find are confirmations, right? Mm-hmm. It's like at the symposium that we had when somebody had brought up earlier today about Dow theory.
Yeah.
And I look at that in the economic data. Like I actually will look at the non-farm payroll numbers, and I will look at what happened with I'll add up rail transports, air transports, truck transports, and I will look at the very cyclically sensitive, and I always look at what did they do against what did durable goods manufacturing as a proxy for industrials. So I know I might be boring you with stuff like this, but that's very powerful information. Looking for data beneath the data, beneath the veneer. Retail sales. Look at retail sales. Strong, weak. Okay. Downward revisions, upward revisions. Okay. 10-year note yield moved down 3 basis points on the numbers. Okay. That stuff. But there's enduring stuff beneath the surface. So you have to be a detective. Like, for example, why would I, for example, want to look at retail sales or consumer spending on clothing? Why clothing in particular? Because it's got the highest correlation with something very important if you're an economist, which is employment, okay? Because nobody goes to a job interview naked, okay? Normally you'll buy a suit. You'll dress yourself up. That's the highest correlation with employment is retail sales of apparel, as one example, or say restaurant sales. Restaurant sales are actually the best leading indicator for all other discretionary spending. Why is that? Because when times get tough, that's the easiest thing to cut out of the budget. You'll just eat at home, as opposed to taking the family out, at least for a period of time. So you're always sort of looking for these nuggets and these clues. So I sift through the data, and I've been doing this for 30 years, so it's just experience, and I just know what to look for.
Yeah.
And so then I write about it. So it's a different, whether it's retail sales, industrial production, durable goods orders. One thing I'll guarantee you, I can't guarantee I'm going to be right all the time, okay, because I won't be. But I guarantee you that, and this is what I strive for, is to give you information that will be helpful, that you will not be able to find anywhere else. And then, of course, look, the markets are moving every single day. And so, look, a lot of it, and then I'll get hit with some big picture stuff. I have eureka moments all the time. I will sometimes jump out of bed at 3 o'clock in the morning, and I'll run straight to the home office and jot something down so I'll make sure I don't forget it. For example, I was trying to figure out, this whole, like, how did we have this last year? Like a 30% return on the stock market in the context of a 4-quarter earnings recession. 4-point multiple expansion. And even you can talk about interest rates, but really what else was happening out there that could justify that sort of multiple expansion? I mean, what happened last year has only happened one other time outside of recessions. When you come out of recession, you get huge multiple expansion in the context of earnings that are still weak because you're pricing in a much brighter future after the recession ends. And we're more than 10 years into this thing. So I got hit with this idea where, and this is where, by the way, so I hired on my team the econometrician from Toronto Dominion Bank, who built up all their macro models for what? For the BIS stress tests. This guy came on board. And it's great to marry, the raconteur part of this and have rigor attached to it. So it's really the first time I got to tell you since my days at Mother Merrill in New York where I actually have that quantitative backup. So we ran these regressions, which of course is what economists do since we're not accountants. We won't do T accounts, we'll do regressions. And found out actually that for the first time ever, there is only a 7% correlation between the movements in the stock market this cycle and the movements in the economy. Normally, it's between a 30 to 70% correlation, depending on your starting point and the multiple, which also is very important. And so I'll get hit with these ideas. That's just one idea. And then I'll write about it. And then we'll flesh it out and write about it. And this all starts in Breakfast with Dave. And next thing you know, we'll put it into a full-fledged big report on its own. So a lot of it is just basically, that's what I said, a lot of it is small picture, data, stuff that the markets move. What does it mean? Is it for real or is it a head fake? But a lot of the time, the wheels for me are always turning, no matter where I am, and always trying to come up with creative ideas.
So, what do you think is one of your more controversial, or maybe not controversial, but in the last 10 years or so, let's say, something you found in the data set that people weren't looking at, that either caused a big uproar? In the internet world we live in, that can be a lot of hate via the social media platforms or the like, or had a lot of interest, or people say, "Aha, I never thought of that." What's a couple of those nuggets that you have out there?
Well, I'll give you one nugget, which is that 2011 or so, believe it or not, I started to turn bullish.
This was talk of the double dip recession.
Well, that's right. And I had been basically caught in the vortex of that back in 2010. But starting in 2011, 2012, there were some things I was starting to notice in the data and how the markets are behaving. But mostly in the data, I am data-driven. But data that give you a view through the windshield, because too many economists are just stuck in looking at things through the rearview mirror. So some things started to change. And as the one thing that you can't be in this business is you can't be stubborn. I mean, you have to have a backbone. But maybe the best thing John Maynard Keynes gave to the world was that quip about when the facts change, what do you do, sir? Now, look, you can't whack your forecast all over the place. You have to have a view. But this was a big change in my view because I had been bearish. Stayed bearish arguably for too long. I'll say this much. The reason I got the perma-bear status was because in that whole period from 2002 to 2007, I never turned bullish once. Okay, I just didn't. I just got to New York in 2002, but I didn't get mortgage equity withdrawal. How these mortgages were being priced and bundled, and how you can get more than 100% loan-to-value ratio loans, and how the savings rate went negative. A lot of funky things.
Just because house prices always go up, right?
I just have this saying that when you don't understand something, just stay away. So I stayed away, but I did make a vow to myself, coming out of that last cycle that, you know what, I want to learn from my mistakes, and I'm not going to stay bearish longer than I have to. Now, the first couple of years of the recovery, I was a big skeptic, and it's on the record. But when I turned bullish in, say, 2011, 2012, wow. The bloggers, everybody. I mean, I got to say, I don't know if I'm people's teddy bear, that they have to fall asleep with me at night. But it was I went through a lot. A lot of people were actually very angry at me. A lot of the long-term bond bulls. I'll tell you the truth. I'll tell you, some people unsubscribed. Okay, from my research, because and like they're thinking, are you buying my research because of my view, or are you buying it because of the quality of the thought process? But it was a learning lesson. But that was something. Then of course, and then I turned bearish a couple of years ago, and increasingly so. But that was like one call, and I did. I lived up to what I said I was going to do. No one is ever going to capture the whole market for you, the whole cycle, and shudder to think that if they do, because if you overstay your welcome in a bull market, the problem with the bear market is that it's a trapdoor. It's basically an elevator going down. A bull market is an escalator going up. So that was just one example of things that I started to notice, and a lot of it just came out of more. Hey, I could say my favorite leading indicator has always been the yield curve, but there was other things going on at the same time, and the forward-looking data started to look a lot brighter to me at that point. Mm-hmm. So this is one example. The other one is my view on inflation, and that structurally low inflationary environment, that backup in bond yields will happen. I don't know if it was just luck, but I caught most of that 200 basis point back up in the 10-year note from the summer of 2016 post-Brexit all the way to the peak of November 2018. But I've been a long-term bond bull, right up there with my good friends Lacey Hunt and Gary Schilling, and so that's been, and especially in the past year. In the past year, although I'll say to people, you're right, I was not bullish on the stock market enough. That's obvious, but a lot of that return just happened with that QE4. Right. But sticking to my guns on the long bond held you in good stead.
So when you open up the data set today, right, you're turning the calendar year into 2020. What is it telling you about the U.S. Economy? What does it look like today? What are the highlights? What are the lowlights, if that's a word? But what are you seeing in the positives, negatives, and how do you balance all that? Obviously, you're just providing the data. You're not saying this is exactly what you need to do. But how do you look at the bag of data today?
Right. Well, in a word, fragility.
Okay.
And this, again, is where you have to really put on your economic historian hat. And maybe in some sense, go back to biology in high school, because the economy really is it's a living thing. It's an organism, and you don't shock one part of it without there being some after effects on other parts. So let's look what happened. You always have to take a look, because there's always, at any given moment of time, there's some sort of shock that's happening. Things are not stable. Okay, that's one thing we know about change, is that it's constant. So we actually had a monetary policy shock. The Fed, no other central bank did this. The Fed did raise rates 9 times, most of that under Jay Powell. And they did undertake quantitative tightening, where they reduced the size of their balance sheet for a period of, say, 3 or 4 years. The net impact of that tightening of policy was the equivalent in total of roughly 400 basis points.
When you bring the balance sheet into it.
When you bring the balance sheet into it. And what we know is that there are lags, and the lags are long and they're variable. And they could be as short as 12 months and as long as 36 months. People tend to forget that Bernanke's last rate hike was in May of 2006. And the recession that nobody saw coming was a year and a half later. And you can just go back in history. And it's not the first rate hike that's the mistake. It's the last one. And as if the one that we're talking about is December 2018. So from my vantage point, we came off a monetary policy tightening cycle. which, by the way, did end up for a short period inverting the yield curve.
But also on top of that, they were continuing to unwind the balance sheet. I remember from September of 18, Powell's comments about automatic pilot, or actually that was the December press conference. It was the automatic pilot.
Yeah.
We're hiking. Everything's fine. Don't even look at the balance sheet. Right? It was the sleight of hand. Like, look over here. Look over here. We're hiking. Don't worry about the balance sheet.
Right.
We got it all under control. Monetary policy is best affected through the Fed funds rate. That was the message that was just beating us over the head. And it was kind of being naive, I think, with the benefit of hindsight, obviously, but that it was that the balance sheet matters. Right?
Yeah, the balance sheet definitely matters, and that's why they're moving in an opposite direction right now.
Right.
And so once again, if you look at history, and history is important. Look, it's never it's similar but not the same. But the reason why history is so important is because patterns emerge. And we're odds makers here. I can't sit here and tell you there's a 100% chance of a recession, but I could tell you that it's my base case, but not necessarily my only case. But what if I told you that historically when the Fed engaged in a 400 basis point plus tightening cycle, the odds of recession in the next 12, 24 months was 80%. Now, I'm not saying the next 3, 6, 12 months, but you know that it's out there and you know where the odds are. And in fact, what's interesting is that the New York Fed model, the modified New York Fed model got to 80% last summer. And now it's basically below 50 and everybody is in jubilation mode. But it doesn't – this is exactly where it is. Usually at the time of recession when the yield curve's already re-steepened because the Fed's cut rates, but it's too late. The damage has been done. I might be from Toronto, but I'm close enough to Quebec to know the old term "les jeux sont faits," which means that that it's in the cards, basically. So the way I see it, we had a monetary policy tightening cycle, and as you would expect, it hit the interest-sensitive sector of the economy first. What was that? It was housing. Do you know when I tell people that residential construction and the national accounts data has been negative for 6 of the past 7 quarters, nobody believes it. They go to the data to find it. And, of course, maybe we had a bull market for a good while in multifamily housing, but single-family was never that strong, and that's the dominant force. Then in 3 of the past 4 quarters, we've had commercial construction in its own recession. 2 of the past 3 quarters, capital spending, which has dried up, has been flat or negative, and now it's hitting exports. So we had a monetary policy tightening cycle. On top of that, we then had from the monetary policy shock, we had the trade shock. And once again, everybody is jubilation because of phase 1. What does phase 1 really mean? I mean, once again, les jeux sont faits. The gig is up. That people don't realize that the damage has already been done. The average tariff rate on imports from China is 16%. Okay, so we didn't go with the tariffs at Christmas time. That's great. But before the trade war started, the average tariff rate was 3%. Now it's 16%. And this is a long-term war, not just of economic power, but of ideology. This is actually the first time in our lives. Anybody that's alive today has not seen this, where the U.S. economic hegemony is being challenged by another power. Mm-hmm. This is not like the Cold War, which is more of a nuclear buildup war. This is actually an outright economic war, and phase 1 was really expedient for the president to not have to generate a consumer recession heading into an election year. And, of course, the biggest irony last year was that in the Chinese year of the pig, a third of their pig population got wiped out by the African swine flu.
Be careful, you can't write about that. Someone made a headline about that. I think from UBI, that's right. Well, I'll just talk about it. I won't write about it. But the thing is that so it was really a phase 1 of necessity, but it doesn't really change a whole lot. But
you mentioned the hegemony. What about the dollar status there? What do you think about it with that challenging the world's reserve currency as well? Because you're talking about the economic challenges to it. What about to the ultimate currency?
Right. Well, I'm not bullish on the U.S. dollar, and I'll tell you why. It's because I think that the Fed, I think the economy. When I said fragile, I think recessionary pressures are going to build. I think that inflation, underlying inflation, because we know what oil is doing, of course, not included in the core, but. Right. But that's going to be a deflationary shock on the rest of the economy insofar as oil prices continue to move higher because of this new geopolitical risk. Mm-hmm. But underlying inflation is going to continue to frustrate the Fed to the downside. The economy, I think, is going to remain weak. I think that Donald Trump is going to continue to use Jerome Powell as his personal pinata, but I think that irrespective of the political pressure, I think that there will be economic pressure for the Fed to cut rates at a time when most of the rest of the world is pretty well done, and those compression of interest rate differentials will lead to a weaker U.S. dollar. So I'm bearish on the U.S. dollar, but even though we're seeing we are seeing the People's Bank of China and Russia. Some of the major central banks are increasingly gravitating away from the U.S. dollar, interestingly enough, and they've been moving into gold. Mm-hmm. Well, gold's not going to replace the U.S. dollar as the reserve currency.
It's not enough of it to go around, really.
No, well, the problem is that I do think about that. I mean, I don't know if we'll see that in our lifetime. Mm-hmm. I think that there will be a time, and history will bear this out. Or then again, maybe the U.S. is just still going to be the best experiment in humanity of all time, or certainly in modern history of and having property rights and stability on a relative basis still matters a lot. So,
which is kind of the crux of part of the trade war too, right? Or at least that's what it looks like on the surface too. Is the violation of the IPE and
right. That's exactly no property rights. I mean, so that's why people say to me, and a lot of them are the gold bugs, and I like gold too. In fact, some people call me Goldberg, but no, it's still Rosenberg. But the question is what's the alternative to the U.S. dollar? Is what is the other reserve currency? And it's certainly not the renminbi. And people were saying, I remember all the way back to 1999, when the new kid on the block was the euro. Oh, the euro was going to supplant the U.S. dollar. Back what was the IPO? 120 and the euro, and
it sounds about right. Then it just collapsed almost immediately.
Right. Yeah. So anyway, it's but I am bearish on the U.S. dollar for relative monetary policy movements, but I don't think that we're going to be necessarily moving away from the U.S. dollar as reserve currency just yet. I'll tell you this much though: it is interesting that everybody's debating what the Fed is doing on its balance sheet. Can you believe that in the past 4 months, more than 100% of the fiscal deficit has been covered off by the Fed's balance sheet. Right? And you sort of sometimes think, don't emerging markets tend to do that? Or you don't usually look at that from these. And that's the one thing that I'm thinking about when historians write about this period. But I'm talking about historians like maybe 100 years from now, that maybe this was actually all the stuff happening right now, trade wars and central bank intervention at a time of 3.5% unemployment. I mean, this is sort of stuff you expect to happen, in a recession.
Yeah.
Recession hasn't even started yet. So, look, you start thinking about these things, but the reality is that there is no alternative to the U.S. dollar just yet.
So with that, on the historian part, looking forward, 10, 20, 100 years, are people going to look back and see this experiment of monetary policy through balance sheets as a failure or a great success, do you think?
Well, I think that probably is a failure, but they're not done. They're not done. All this is just part and parcel of what they call, let's just call it, non-conventional policy accommodation. I think negative interest rates, that will be viewed as a big mistake, and for a whole host of reasons. I think that what's going to happen ultimately, and this is how we're going to have to reset everything to the next cycle, is we have to have a giant debt default. Mm-hmm. Now, it could be nasty or it could be benevolent. When people talk about modern monetary theory or the magical money tree, there's really nothing new there. Everything anybody ever needed to know about anything the Fed was going to do for the next decade was right there in Ben Bernanke's, Governor Bernanke at the time, in his famous November 2002 speech that he gave, where almost every acronym the Fed ever did, from TAF to TALF, was in there. Mm-hmm. But the big bomb, which was debt monetization. Well, the Fed never went that far.
He was doing the Japanese, though, for so long, right? And it's like we followed in those footsteps, right?
Well, he talked about quantitative easing in that speech, too, but you see, they didn't go that far. They took the funds rate to 1%, left it there for a year as GDP repped from June of 2003. That was the last rate cut, was June of 2003. The recession was already over by almost 2 years. They were still cutting interest rates. And then they left them there, and then they realized it was like Mary Shelley's Frankenstein. They created the monster, which was the housing bubble, and ultimately it had to get torn down. But Bernanke Bernanke is a genius. There's no whether you agree with his policies or not. He's really is a monetary policy genius, and everybody knew that when he came on board in I forget if it was 2001, 2002. He was like the Richard Clarida today. Everybody knew that Bernanke was going to be the guy to ultimately replace Alan Greenspan, and he was. And a lot of the speeches he gave at the beginning of his tenure as governor had a lot of heft, and it's when you think about it. He talked about a lot of the things they were going to do, and then it was basically, 7 years later that they started implementing it. But they never went with the big bomb, which is what you would call, well, in fact, he called it a money-financed tax cut. It could be different ways. It really is just basically what happens is that the Treasury takes a $5 or $10 trillion perpetual coin, or call it a century bond, places it on the Fed's balance sheet, and the Fed
It was the
prints.
$1 trillion coin, right?
That's
Why
it.
didn't people talked about the $1 trillion coin?
Well,
right?
the modern monetary theory people, because there's no spending program they're not going to sign on to, so they're not going to sign on to. So, you green energy here and infrastructure there. I think that what we would want to do if you're going to embark on this is, and I think that actually at a period where you have this global output gap, we still have a deflationary output gap globally. So I'm not actually saying this shouldn't happen. This actually is probably going to happen. We have to have a benevolent, we can call it taxpayer supporter if you want, taxpayer in the future. But we have to have, and it's written in the Old Testament, by the way, as I put on my religious hat, but I'm not religious, but whether you go to Leviticus or Deuteronomy, you're going to see the references to something called the debt jubilee. It's there. So that's the way I see this cycle. Now, the reality is that the Fed at that point loses control of the monetary base, and at that point we'll be talking about big inflation. And it can't just be the Fed alone, or else the U.S. dollar will collapse. So it has to be the BOJ and the ECB and the Bank of England. But when it came to cutting rates and dollar swap lines, and it came to QE, it was all coordinated central bank action. This will have to be coordinated on a global scale. But what we have to do is reset the button, because the global debt is the biggest tourniquet. We'll talk about aging demographics, yes, in the industrialized world, 100%. We could talk about the disruption from technology, robotics. Maybe one of the reasons why wage growth hasn't done a whole lot is because you're not fearing your competitor, who's a human being but who's a robot who can do your job now. Not just parts of it.
Doesn't require pay hikes either, right?
Yeah,
right.
And so there's these secular forces. But I would say that the most pernicious constraint on aggregate demand globally is the level of debt. This has been the mother of all debt cycles. I mean, that's all I wrote about when I was at Merrill Lynch. From 2002 to 2007. You look at global debt from 2002 to 2007, peak to peak, debt went up $30 trillion. GDP globally went up $25 trillion. Okay, so would you say that debt went up by 20% more than GDP?
Yeah.
Look at this cycle. This cycle from the 2007 peak till today, the level of global debt has gone up $128 trillion. $128 trillion. And GDP, the income to support that debt, has gone up $27 trillion. So you're talking about a situation, this cycle, where people are talking about, well, it's been an economic growth cycle. Yeah. Finance. I mean, the level of debt went up by a factor of more than 4 vis-a-vis the increase in income. And here we're left with this massive amount of debt that really has come at the expense of future consumption and investment. This is what we're left with. So we've tried, good grief, we've tried to reflate our way out of this debt, haven't we? We've tried every which way with negative interest rates, endless quantitative easing, free money for a decade, and there's something structurally amiss here. So I think that's how the cycle ends, is we have to basically reset the dial, and it's going to take – and I think this comes in the next recession. I mean, remember how the Fed fought the housing recession, took the funds rate to 1%. Who would have thought that was going to happen? Negative real rates for an extended period of time, followed that up with QE in the next cycle. Just think of how hard they're going to fight the next recession. So I actually think this is very, very plausible. And that's where, by the way, if we do it right. If we and look, part of this is going to be eliminating whatever the 1.7 trillion dollars of student debt. That's like nobody talks about that. I mean, we're talking about Medicare for all, talking about all these other things, green energy. Nobody talks about, actually, I would say one of the most fundamental constraints on the economy is the fact that the millennials and the group behind them are just strapped with too much debt. They have no FICO score. That's why we had no normal housing recovery. So I'd say, yeah, you're going to say, oh, so you're going to bail out the sinners. We already uncovered the moral hazard in the last cycle, okay? So the answer is yes. I think that debt monetization or the debt jubilee is going to be the final chapter. And if it's done right, I think that, and we can eliminate the debt, and of course, it ends up getting put on the Fed's balance sheet to perpetuity. It has to be viewed that this is actually a permanent change.
Yeah.
I think that then we will probably go through a more sustainable period of reflation and aggregate demand growth.
So as you think about it, and you're laying out the case for the recession, is it going to be a deep recession? Is it going to be prolonged? Is it all a function of how the masters of the universe, that's what I call the central bankers these days. It's no longer the hedge fund people. It's definitely the central banks that are the masters of the universe. Are they going to be able to respond quickly, handle this problem, or is it going to be deep? Because I think when people talk about recessions, it used to be recessions just part of the business cycle, right? It's essentially a corporate restructuring. You're talking about essentially a global debt restructuring, but it's the same idea. But what's happened in the last two recessions in the U.S., they were pretty severe, right? And one was kind of concentrated in tech and telecom, and it bled over into fraud and all, and really kind of hit harder. But then we had the financial crisis, which everybody thinks that's what a standard recession is. Is it possible to actually have just a standard recession, whatever that means, where it's 3 to 5 quarters, it's not this thing is prolonged, or is it going to be that we're going to have to face the music and it's going to look like perhaps the last one? Obviously not in the same capacity, It's not the same drivers, but I'm saying the magnitude, the fear, is it going to get to that level?
Well, look, there's no get-out-of-jail-free card here. And what I mean by that is that the recession, the economic recession, is probably going to be rather mild because we don't have a lot of the economic imbalances. The imbalances are more financial imbalances. It sort of reminds me a little bit of, the cycle that you mentioned, which was the dot-coms, where we had a very mild recession. In fact, when you look at the GDP numbers today, you can hardly see the recession of 2001 and 2002. That didn't stop the NASDAQ from collapsing, whatever it was, 70, 80%, and the S&P was down 40%. So you could have deep recessions. I would say that the recession of 1990-91 was a deeper recession than, and yet the stock market was down 20%, not 40%. So a lot of it has to do also, where's the multiple,
It's valuation.
It's valuation. The starting point of the valuation is very important. But I think this time around, I don't think that the recession is going to be measured so much by magnitude or peak to trough decline in economic activity. I expect it's going to be mild in that respect. But getting out of it is going to be really difficult because we don't have the traditional bullets. You see, you're not normally running trillion-dollar deficits at the peak of the cycle. You're not normally running structurally high deficits. The deficit GDP ratio is almost 5%. Well, there's the law of diminishing returns right here that the fiscal stimulus, by its very nature, because of how bloated the deficit is, to run bigger deficits on top of this deficit, the incremental impact on GDP is going to be pretty small. That's why normally, if you go back historically in the post-World War II period, on average, at the peak of the cycle, we're running close to a balanced budget. And that's why when you go into deficit stimulus in the recession, it could be so powerful. Ain't gonna happen this time around. The laws of diminishing returns, the first thing you learn in Economics 101, applies to fiscal policy. What else does? Monetary policy. That's what Powell was trying to do. Powell was trying to push the envelope. He wanted to normalize interest rates, whatever that concept means. Kept on pushing the envelope. How high can I go? How high can I go? How high can I go? What do you know? Wow, I can only get to 2.5, 2 3/4 on the funds rate is pretty sad. And so here we are, say, call it 1 3/4% of the funds rate. they've already cut rates 3 times. But you see, in a recession, the Fed cuts the funds rate on average almost 500 basis points. So for people that say, well, can we go to negative rates in the U.S.? And most people don't think that that'll happen. A lot of the Fed officials will publicly say that's not going to happen, including Powell. But I got to tell you something. If you go on the
Brookings Institute, right? I would say that Bernanke's been out there again over the weekend talking about it once again, right?
Yeah.
Right.
But you go a lot of the Fed district banks. Interestingly enough, especially San Francisco, which is where Williams comes from,
Right.
have been doing a lot of work on negative rates. So look, we'll say that maybe they don't go to negative rates. I think they go to what they now call the lower bound, since they don't call it the zero bound anymore. It's a nice little nuance. But they may not go to negative rates, but they didn't go to negative rates last time either. But what they did was they created a de facto synthetic negative interest rate through quantitative easing.
Sure.
And I think that's probably what they'll do, is probably get even more aggressive on QE.
I always wondered is the study kind of comes from Wu and Shaw, right? From the one of them was at the Atlanta Fed that created that kind of economic equivalence. I would wonder is it really this idea of economic equivalence that QE is the same as rate cuts, QT is the same as rate hikes, and therefore it doesn't matter if we have a minus 300, minus 400 basis point rate. I feel like that has been injected into the economist's, vocabulary now, because it's like, oh, well, look at this. This model says that you're the same either way. So there's a definite impact to the worker who is depositing their check into the bank. If you're taking 300 basis points away from them every year versus someone, let's say doing debt monetization and creating some other way of stimulating to make this equivalent argument. So that's what I think is the fallacy of the negative interest rate policy, is that we're arguing its equivalence, but it's not to the end user of the financial system.
Well,
I'm just talking about the banking system as a whole.
I know,
right?
but it's okay. So, so whether they go negative or not, we've been say either zero or negative real after inflation for a long period of time, and it's just a different form of exactly what you're saying. It's the ultimate form of financial repression, which is what this is. But you see what they're trying to do with either low rates, and of course negative rates is the problem with negative rates, of course, is you get to these levels where you can't possibly do any reliable valuation on anything. You've destroyed the time value of money. You've turned borrowers into lenders and lenders into borrowers, and it's this bizarro world.
That's right. I love the research title. I think it was Merrill or someone that had put it out a couple of years ago. It was bonds for capital gains and stocks for income.
That was mine.
That was yours.
That
Okay,
was mine. Yeah.
Okay, great.
Yeah.
Sorry.
But kudos to Goldman if they borrowed that. That's okay. How many original ideas are there out there? But yeah, that was that song.
But that's the bizarro world.
But
you're
that's
talking about.
ongoing. I wrote about that today. That I saw two articles over the weekend. So this I also read vociferously. So whole section and Barron's on income equity and dividends. And wow, a year after growth once again smacks value, and everybody wants to be in growth stocks and momentum. That there's a whole section in Barron's 11 years into the cycle on playing from the front tees by getting the dividends. And so I thought that was, and so how do you get income out of the equity market? So, and that's the anomaly really, is the cap. Look, last year, for example, the long bond returned 20%. Well, because the capital gain. The coupon started the year like a 3. So that's really the anomaly. But then again, the stock market did have a great year, and a lot of that was the capital gain. Can't take that away. In terms of this concept of the financial repression. So what are these central banks doing in their economic models is they want to almost scare you into spending. They want to tax. They want to tax your, say, precautionary savings behavior. They want you to spend.
I love that you call it a tax, because I've always viewed the negative interest rate policy as a tax on who has it. It's the wealthy, it's the savers, it's where the money is. When
Ben Bernanke embarked on QE2, which was in 2010, it was rather unexpected. The day it was launched, actually, the stock market didn't do anything. But the S&P 500 was up 2% the very next day. Do you know why? Because Bernanke had planted a column on his own in the Washington Post on why the Fed did QE. And it's right there. You can just bold it. It's right there. The wealth effect on spending. The Fed and their brethren around the world still believe in the wealth effect on spending. So what they're trying to do is penalize your precautionary saving behavior to go out and spend. At the same time, by cutting interest rates or by making, say, bonds look less attractive to equities, you generate this equity wealth effect on spending, or you bring interest rates down. Your hope is that it's going to spur on home ownership demand, so you'll get an added wealth effect through housing prices, which, by the way, as we saw in the last cycle, could be even more powerful than equities, since there's more homeowners than there are actually people that own equities directly, or at least if they a lot of people don't even know they own equities directly, but they have it in their pension plan. So that's really what they're trying to do. And this is what I'm saying. We are in a, look, I went to university in the late 70s, early 80s. These are, and I learned from textbooks today that I think we just have to maybe throw them into the waste paper bucket. These are not the cycles, the fundamental cycles of productivity and business investment and inventories. The classic inventory cycle, actually the cycles that Alan Greenspan cut his teeth writing about, back in the 40s and 50s. These have become, and this is the other irony, is this started with Greenspan and the Greenspan put. What does a Greenspan put even mean? And then it became the Bernanke put, the Yellen put. Now it's the Powell. It's the
What's
Powell
the Powell
put.
pivot?
The Powell pivot. But
that's at least alliterative. Right?
yeah.
Right.
So it's an interesting phenomenon that and this is what historians will be writing about. This is why it'll be deemed to be a failure, in my opinion. Is that this is now, I believe, the fourth cycle of asset inflation and debt accumulation. The fourth in a row. Started with the commercial real estate that brought down the savings and loan industry in the late 80s and the LBO craze, if you remember that. And then the Fed has to clean up that mess, and we take the funds rate down to 3% negative in real yields. Then we have the next one, which is the dot-coms. Once again, asset inflation, debt accumulation. That bubble bursts, take the funds rate down to 1%. So let's get this down to 3 one cycle, down to 1% the next cycle. And then, of course, we have the housing situation. Once again, asset inflation, wealth accumulation, and that's what that cycle's all about. And then we just take the funds rate down to 0, then do QE to create a negative synthetic interest rate. So let's get this straight. We go from 9 7/8 down to 3, the late 80s to the early 90s. 9 7/8 down to 3, and then we go from 6.5% down to 1, and then we go from 5 1/4 in the last cycle down to 0 or negative. And now we peaked at 2 3/4, and people don't think we're going back down to 0. We'll just look at the perfect symmetry here, and it's the same cycle. It's just that we've just rotated the chairs, right? It's another cycle of debt accumulation and wealth accumulation and a massive debt run-up, and in fact a much bigger global debt run-up than we had even in the last cycle. So really, how does this ultimately end? And I'm actually struck at the fact that, when I mentioned at the beginning of your show that there's only a 7% correlation between the stock market and the economy, I mean, well, how could that be? How could it be? Like, if you'd have told me, the only statistic that I knew was that the corporate sector used this low-rate environment to flood the market with $4 trillion of new debt issuance, I would have thought, wow, we must be having the mother of all capital spending cycles. It's the weakest capital spending cycle of all time. That's why productivity is actually starting to erode, which is why I think employment is going to follow suit. Companies have overhired. $4 trillion of corporate bond issuance perfectly went into $4 trillion of share buybacks, giving you this allure of an upcycle earnings per share, where actually the level of earnings, if you go to the national account numbers, haven't budged in 5 years. So it gives you this allure of I'm buying equities. You're buying actually a commodity. The equity market's turned into a commodity, and the share count's gone down to a 20-year low. It's like I want to be bullish on copper because all these copper mines in Chile have been shut down. I mean, that's basically what's happened in the stock market. It's become a commodity with no correlation with the economic outlook whatsoever. We've just basically turned everything upside down here. So we have, and to me, this is actually the principal risk. And we talked about this earlier, which is that we have. If I showed you the chart of corporate debt to GDP, it looks a lot like the mortgage debt to GDP cycle in the last cycle, and we knew how that ended, and it was just a matter of time. I was crazy early on that call. A year and a half later, nobody remembers how crazy early I was, and I think I was been crazy early on this call too. But I know that we're probably on the same page on this score. That's really where the bubble is this time around.
All right, so that was all prompted by the good and the negative in the data. I don't recall hearing much good in that data. Do you have any bright spots in the economy right now?
Well, I'm trying to.
You don't have to.
Well, let me just say, firstly, big picture. Look, you cannot be denied. You cannot assume this away. That last summer, for a period of a few months, the New York Fed recession risk model went above 80%. That's a foolproof recession indicator. It's a matter, is it a 12-month lag or 24-month lag? Is this going to be something that we see in the first quarter, which is right now, or the fourth quarter? And frankly, I don't think anybody is smart enough to time it. You just have to know that it's out there. I'm taking a look at the leading economic indicator from the Conference Board, and the year-over-year growth trend this time last year was 5%. It's really interesting that at a time when everybody was hiding under the table because of the stock market down 20% and, the credit market froze up for, God forbid, 2 months, GDP growth actually was hanging in pretty well. That shows you, again, the disconnect between the markets and the real economy. That year-over-year trend in the LEI, leading indicator, is now down almost to zero. And when you strip out the stock market, because that's one of the 10 components, the Conference Board still has the stock market in there because it believes that it's still a leading indicator, but it hasn't been for a long time. But let's just say that when you strip out the stock market out of the LEI, it's actually running negative. And so that's telling me a certain impulse that if we don't get a recession, it'll be the next level, the next rung on the ladder. What am I looking at right now? We talk a lot about the November election. We have to talk about it here, but this is actually, let's assume that it's Bernie Sanders against Donald Trump. This is okay. So Bernie Sanders is maybe a different version of Elizabeth Warren, but we know that he's going to raise taxes. He's going to rescind the corporate tax cuts. He's going to do a whole bunch of stuff that is not friendly to the business sector. Well, why would you commit capital if you're a company this year? Like, you might be able to determine what your ex-ante cost of capital is going to be, but you're in a fog about what your ex-ante expected rate of return on capital is going to be after tax. So that's a bit of a problem. So I can't see the case. I think that this phase one was a bit of a ruse and political expediency for the time being. I think that we're going to be in a rocky road as far as China-U.S. relations are concerned. So I don't think that this trade war has come to an end. And I think that is going to have an impact on supply chains and have an impact, again, on capital spending. And then on top of that, I guess that there's a couple of things that you could argue are looking a little bit better, given that interest rates have come down, maybe, and the home building stocks, of course, maybe that's one area of the economy that still has some leading properties. Maybe you can build a view that housing will be okay, maybe the home improvement will be okay. But it's all in a relative game here. I said before that it's a game of dominoes. I compared the economy to a living being. We've already shocked housing. We shocked commercial construction, shocked CapEx already, and now we've had the export shock. And the consumer does not live in a bubble. Okay, and I think that the consumer hung in very well last year. There's no doubt about it. And you're not going to have a recession when 70% of GDP, called the consumer, doesn't go down for the count. Didn't go down for the count. Why? Because employment stayed healthy. Well, I wouldn't actually extrapolate into next year. And I say that primarily because the one thing that really bothers me is the fact that there was no capital deepening this cycle. The bull market was not in capital spending. If you're a real supply sider, isn't that what you want to see, especially at a time when we know the demographics, we know the labor force growth because of the demographics and the aging retirement boomers is a fraction of 1%. We need the productivity. Well, apparently, wasn't the repatriation of all the capital from overseas with the tax changes and the end of the inversions? Wasn't the corporate what happened here? The bull market was in financial engineering. The bull market was not in capital spending, but you see now it's coming to roost in the productivity numbers.
Yeah.
And so that's going to be the key test. I think we're going to have back-to-back negative quarters, Q3, Q4 productivity. That's a signal of the business sector that we overhired, and I think we're going to have a different employment picture. Now, whether or not it goes negative, that remains to be seen, but I think the unemployment rate is going to start to go up. And that's not usually a very good thing in an election year, with or without a recession. But you're quite right, I'm trying to find where are the nuggets that are going to create a reacceleration in growth. Well, the question I would come back is why would you expect that if the leading economic indicator on a 12-month trailing basis is down almost to zero, and it's basically back to where it was a decade ago? It's I said before, let's drive by looking through the front window, and the front window is one I said is one of economic fragility. I don't want to sound overly bearish here, but I do want to say that you want to be prepared for, I think, a pretty rough year, or to say it politely, a challenging year for economic growth. And it actually tells me you want to be less cyclical in your portfolio. You want to actually have less risk in the portfolio. But I do think that in this period where deflationary pressures are alive and well, that you should continue to think about how you can derive income in the portfolio, whether that's through dividend growth, dividend yield, and low payout ratios in defensive parts of the marketplace. And by the way, I would say utilities fit that bill. Notwithstanding their valuations, they tend to get bid up at this stage of the cycle. And I would still say I like the Treasury market.
Right. Well, I think we're going to have to cut you off there. I mean, I think I got my 3 questions in as we talked, so that was one more than we thought we would get. But all jokes aside, it's just always just great to wind you up and let you go. I don't think you speak fast at all, but that's coming from someone who people tell me I speak very quickly as well. So before you leave, though, you know the drill. Sam's favorite part of the show is coming up, so cue Sam.
Yeah, before we get to that favorite part of the show, maybe it's helpful to let our listeners know how they can get a hold of you at your new shop.
Right. Well, I would say that go to the website, Rosenberg Research or rosenbergresearch.com, and if you want to email me, it's Rosenberg at rosenbergresearch.com.
Convenient.
There's right now it's opportune because I just actually today put out the year ahead outlook. And January, for courtesy purposes, is free for everybody.
Wow!
So you can come on, check it out for yourself, and hopefully stay on as subscribers, like so many have over the years, and hopefully it'll provide value added for everybody.
Well, I've got to say, you did hear it here first. So free month of January from Mr. David Rosenberg at Rosenberg Research and Associates. You can email him Rosenberg at rosenbergassociates.com, right?
All right, and that takes us to my favorite part of the show, and that is Sherman Says. So, Mr. Rosenberg, rules of the road are I will give you a term or a phrase to which you will provide a top-of-mind response. And what I do is I start off Mr. Sherman and then alternate between the two of you.
And we try to do it one word, but Sam's giving up on that.
Who's going first?
Mr. Sherman
Good.
will.
So
yeah.
I get to learn from the pro.
Yeah. I see him eyeing the back of my Taco Bell, our last Taco Bell order as well here.
It looks pretty.
Reuse of paper.
It looks pretty robust, that order over there.
It does.
Yep.
So what we got here for the first one, Jeff, is overnight repo.
Fragile.
Rosie, U.S. consumer.
Fragile.
I see a trend going on here. Yeah.
Globalization.
Waning.
Automation.
Accelerating.
Iran.
Trouble.
Deflation.
Continuing.
Plunge protection team.
Bring them back.
Fed inflation targeting.
Irrelevant.
Niners.
Super Bowl.
Packers.
Vikings.
If you didn't know, Mr. Rosenberg's a big Vikings fan, so we've got a nice little friendly competition. By the time you hear this, that game already happened. So I'll give him our condolences for the victory from the Niners for that weekend. So anyway, thanks for coming on. We really appreciate it. You've been a great sport. For those of you who don't know, the symposium that David was referring to is something that we posted to our YouTube channel. So you can look at it. You can find us on youtube.com/DoubleLine Capital. You'll see we did about a 3-hour symposium today where all these insights and many more were discussed. It's a great conversation. It's a great piece. It'll help you with your 2020 outlook, we hope. And for those of you that are listening to this too, you can always catch us at doubleline.com. You can find us on Spotify, iTunes, SoundCloud, Google Play. There's a few that I'm missing, but we're always getting new places as well. So again, David Rosenberg, thank you so much for coming in. It was a pleasure to sit here and just listen to you give us your monologue. So much appreciated. Keep up the great work, and we can't wait to read all the great research from your new firm.
Thank you, and Happy New Year, everybody.
Happy New Year. Thanks again. Bye-bye.